Happy Wednesday out there, Team 42. It's your skipper here, Darius Dale, to present our macro minute for Wednesday, October 19th, 2022, starting with our economic release spotlight. So we're going to highlight some inflation data out of Europe. We got CPI data out of both the UK and the Eurozone, the final prints for the Eurozone for the month of September. UK's headline CPI accelerated 20 basis points to 10.1% year over year. That's the fastest print we've seen since February of 1982. I was not even born then. UK core CPI accelerated 20 basis points to 6.5% year over year. That's the highest since March of 92. And then shifting gears to the Eurozone, we saw the final September print accelerate 80 basis points to an all-time high of 9.9% year over year in September, just inside of 10%. And then the core CPI accelerate 50 basis points to an all-time high of 4.8% year over year. These inflation dynamics continue to reinforce the global bond bear market. This is not just a U.S. story. There's a global bond bear market, particularly when you look at money market rates and policy rate expectations for these respective central banks. You have the Bank of England, just looking at their 1 year, 1 month forward overnight index swap forwards. That curve is pricing in 285 basis points of additional policy rate tightening in the UK by the Bank of England over the next year. And then the Eurozone, the European Central Bank, the OIS curve is pricing in 241 basis points of policy rate tightening over the next year. So both those things are obviously up on these inflation prints. This is something that continues to be a wrench in the side of investors here in the U.S. who are looking around at 4% Treasury yields and saying, "Well, I got to go buy the long bond here," not doing the research and doing the understand and trying to understand the dynamics associated with inflation surprises, inflation shocks globally. This is a global fixed income story about the entire world being offsides on duration. And it's in our belief, we're not quite there yet, at least from the perspective of the U.S. economy, which is not yet signaling an actual recession is on the imminent horizon. One thing we'd also flag, shifting gears a bit before we get into our risk management, this industrial production release we saw yesterday morning kind of was snuck in under the radar. But it didn't sneak in under the radar from the perspective of us who were doing the actual research on it in terms of analyzing the rate of change. We accelerated 190 basis points in industrial production growth to 4.1% on a 3-month annualized rate of change basis. That's the fastest print we've seen since May of 22. Capacity utilization ticked up 20 basis points to 80.3%, so 80.3. That's the highest print we've seen in capacity utilization since March of 2008. Now, I'm not entirely sure whether or not we pulled forward industrial production growth and manufacturing into September, in terms of producers trying to get ahead of Hurricane Ian. I'm not sure if that might have made a difference or not. But what we do know is that the 3-month moving average of this 3-month SAR a growth rate of 2.9% is actually 200 basis points higher than the 10-year moving average. We typically compound 1% or thereabouts on a 3-month annualized rate of change basis over the last 10 years each month. We're tracking at 2.9% as of September on a 3-month annualized basis. So it's pretty clear that we're in a booming U.S. economy. We talked about this through the lens of consumer spending. Now we're talking about this through the lens of manufacturing and production. And obviously those things are quite positive for near-term earnings fundamentals. You're going to see, decent earnings in Q3. These are Q3 statistics we're talking about. But the flip side of that is that all of this resiliency in the economy continues to contribute to what we've been calling a sticky and stochastic disinflation process, particularly with respect to core inflation, which is now the key driver of net liquidity. So it's good and bad. I think we all know what the ultimate destination is. So don't get cute out there trying to play for OPEX and things of that nature. I think positioning is only going to get you so far from this point going forward in this bear market. That's our belief. That's our view based on some of these deteriorating macro fundamentals. Shifting gears to our my long board dashboard. Looking at my global macro set of indicators here, just to give you a little bit of rundown on what's going on with the global markets. So U.S. dollar, that's still bullish in the middle of the range there, not much to do. Gold, bearish, that's still in the middle of its range. 10-year Treasury yield, that's been bullish. It's getting toward the upper bound of the range. That's at 4.15%. It's starting to come in a little bit over the last couple of days. So take note of that. That's something we haven't seen in a little bit. S&P 500, that's neutral from a short-term perspective, from a momentum perspective, but definitely bearish still from a medium-term perspective, getting towards the upper boundary of the range there. You got upside to 38.09. It's been creeping higher a little bit over the last couple of days, so don't be in a hurry to reestablish some shorts there. Give this thing a little bit of time to breathe, particularly into Friday's OPEX and maybe even on Monday. VIX bullish on both the short and medium term durations. Not quite oversold yet. We got downside in the VIX here on the Longbow dashboard to about 28.67. That's where you would expect a lot of the Vanna flows that have supported the market week to date to really start to dissipate and sort of open up the room for downside. NASDAQ, that's bearish at the upper boundary, getting towards the upper boundary of the range. You got about 2.5% to the upside. Russell 2000s, that's bearish, neutral, immediate term. We talked about Russell a little bit yesterday. One thing I'd call out is Russell has a little bit less upside at its probable range there. You only got about 1.19% of upside versus 5% of downside to the lows there in the Russell. So just be careful chasing the Russell there. If you're going to be playing an OPEX bounce, we talked about a couple of sectors and industries within the U.S. equity market in our leadoff morning note today that are the most favorable to play an OPEX bounce from here. Although we did give our views on what should happen after OPEX and our short-term key takeaways there in the notes. So definitely go check that out. For those of you who subscribe. And then Bitcoin, Ethereum, those are both still bearish in the middle of the range. Shanghai Composite, that's still bearish in the, getting towards that boundary of the range, but not quite there. Crude, that's bearish, neutral, immediate term price momentum, and it's now oversold. So this is something I've talked about, going back a few weeks ago, which is one of the key risks we saw in Q4 was a potential resumption of energy price inflation. Obviously, if you look at the September CPI data, headline CPI has been flattered to the downside by energy price deflation. We got headline energy CPI down 40% on a 3-month annualized basis, down 40% on a 3-month annualized basis. Now, if we get to the other side of the, President Biden buying votes with the SPR in November and December, what happens to energy markets in the context of this OPEC production quota cut, which is, according to our friend Eric Townsend over at Macro Voices, somewhere around 600 to 800 barrels, million barrels per, or 600 to 800,000 barrels per day. You're going to lose the extra million barrels per day that the Biden administration is leaning on the crude oil market. You're probably going to find some stability. And we're seeing that from a short-term perspective. If you look at momentum, the signal is neutral now. From a short-term perspective, obviously still bearish. So you need to be concerned. Keep your antenna up on energy price inflation returning to the markets potentially in Q4. It's not our modal outcome, but it's certainly, from our perspective, this is one of those things that could be a boogeyman that no one's talking about right now. And in fact, if you listen to every podcast that I listen to, and I listen to a great many of them throughout the week, everyone's super bearish on energy now. They were super bullish on energy in June. Now they're super bearish on energy here in October. So that's quite concerning if you're trying to fade the crowd there. And then lastly, looking at other pockets of the commodity markets, ag bearish, getting close to oversold here. This is the Bloomberg Agricultural Commodity Index, and then industrial metals. That's more or less oversold as well. Although, industrial metals are the most tethered to the growth outlook. So don't be careful. Definitely don't be longing industrial metals here. Shifting gears to my global macro dashboard here, where we're going through 300-ish ETFs representing individual factor exposures across global macro. We're sorting them by the odds feature here, so to help you identify which are the most overbought relative to the most oversold. This morning, we got a near overbought signal in residential real estate here. REM, this is one of the dogs of the year, is this breakdown in residential real estate here in the U.S. And so obviously there's value here. The yields are probably very attractive, but until we really get a handle on the terminal Fed funds rate, which again I think is still being debated by the markets. A lot of folks think 5 is the peak. I don't think 5 is going to be the peak if core inflation proves stickier and stochasticer, or if that even is a word. It's not, obviously, from here. So definitely be if you're short, if you're inclined to be short residential real estate or inclined to stay short of duration risk at this point in the process. This would be a good thing to be shorting. We talked about Europe a little bit yesterday. Eurozone ETF, EZU, is now getting towards overbought territory. Although, again, I think everything's going to trade in sympathy with U.S. equities, particularly into and through OPEX. But again, what happens after OPEX? OPEX is 2 days from now, so be careful if you're leaning long into that catalyst. And then just sort of going all the way down to the bottom of the list, still a lot of the same, a lot of the same exposures we talked about yesterday in terms of commodities: base metals, soybeans, oil, cocoa. The commodity index itself, Nigeria, which is basically cocoa and gas and energy, nat gas and copper, are all those things that are still kind of at the bottom of the list. So, this is we're kind of getting to the point where you could potentially see a rally across commodity prices, from here over the next few weeks, just based on some of these signals, and that would obviously not be good for anybody who's chasing an OPEX bounce or a bear market rally. Again, I've heard some calls for a sustained bear market rally, a la what we saw in June, July, and August. And I would tell you that if we don't have phase two at this point in the process, you're not going to get that. And if you don't know what phase two is, it's because you're not paying attention to 42 macro research. So with that, Darius Dale presenting our macro minute for Wednesday, October 19th, 2022. Best of luck out there today. Cheers.